Most traders don't blow accounts and one big mistake. They bleed out slowly. They take trades that almost make sense. They enter too late, they exit too early, and they trust indicators without understanding what those indicators are actually measuring. The biggest mistake, they treat every signal the same, no matter where price is or what the market is doing. And that's exactly why the same strategy works for one trader and destroys another. Here's the good news. You don't need more indicators. You don't need prediction. You need alignment. And by the end of this video, I'll show you a clean, repeatable setup that's built around logic, not guessing. But you have to stay until the end because the real edge is hidden in the settings. And most people never touch them. Let's open the chart. On the screen right now is gold 1 hour time frame. And before we even think about entries, signals or setup, we do one thing. We observe pressure. Is the market being pushed higher or pushed lower? You can see that pressure clearly using a single dynamic reference on the chart, not as a buy or sell trigger but as a balance point. When price is consistently holding above this line and the line itself aligned upward, buyers are controlling the market. Pullbacks are temporary. Move higher are accepted. That's bullish pressure. And when price is holding below the line and the line is angled downward, sellers are in control. Rallies are weak. Lower prices are accepted. That's bearish pressure. This already removes most bad trades because you're not longer asking, can I buy here? Or you're asking, does buying even make sense here? And that question saves accounts. Now here's where most traders still get trapped. They identify the pressure correctly, but they enter the worst possible moment. They buy when price is extended, they sell when price is already exhausted. That's not a strategy, that's impatience. In the setup, we don't chase a strength. We wait for weakness inside a strength. Let me show you what that means. Look at this gold example. Price is above the line. The slope is clearly upward, so we're only interested in buys. But we don't buy immediately. We wait for price to come back toward balance. That pullback is where risk becomes small. When price returns to this line, it's not a signal, it's a zone. Some pullbacks bounce, some fail. So we need a way to measure whether the pullback is losing momentum and whether buyers are starting to step back in. That's where timing comes in. Now shift your attention to the oscillator below the chart. This level is not telling you where price will go. It's telling you what energy is behind the move. During a strong bullish phase, momentum stays positive. During pullbacks, the momentum cools off. When price pulls back into the line, you'll often see the oscillator dip, sometimes even turn negative. That's not a sell signal, that's the market resetting. The mistake is entering too early. We wait for momentum to reignite. When the oscillator shifts back in favor of buyers and price starts holding above the line again, that's alignment. Pressure plus timing. That's where trades come from. Not because the indicator says so, but because the market is doing the same thing again. Now let's talk about protection, because no setup survives without rules. Every trade risks a fixed percentage of account, 1%, no exceptions. The stop loss is placed where the idea is proven wrong, below the recent pullback low, or clearly below the line. If price breaks the level, bullish pressure is gone. You're not unlucky, you're wrong, and wrong trades are exited fast. Targets are never emotional, they're calculated. At least 1.5 times the risk. That way you don't need to win every trade, you just need consistency. Ignore this and here's what happens. You move stops, you hesitate, one loss becomes 2 and then 3. Rules prevent that. Now let's flip everything for sells. Same chart, different phase. When price is below the line and the slope is downward, selling pressure dominates. We stop thinking about buys entirely. We wait for price to rally back toward balance. That rally feels convincing to beginners, but it's usually weak. As price pushes into the line, momentum often fades. The oscillator starts losing bullish energy. When momentum flips back in favor of sellers and price fails to hold above the line, that's the sell opportunity. A stop loss goes above the recent swing high or clearly above the line. Target is again based on risk, not hope. Same logic, same discipline, different direction. Now, here's the part that actually separates results. The tools themselves are not secret. Anyone can use them. The difference is how they're configured. So, here's the exact setup. The line we use to read pressure and balance is the VWMA indicator, but you must adjust it. Open the settings, set the length to 90. Then go into the Style tab and make it clearly visible on your chart. That length smooths noise and defines real balance, not random movement. The momentum tool is the volume-supported linear regression. In the inputs, set the short length to 50. Then set the long-term length to 200. Then go to the Style tab and disable the second plot option so the histogram is clean and focused. That's it. No clutter, no conflicting signals, no guessing. Pressure first, pullback second, momentum last, risk always controlled. Apply this exactly as shown, and if this helped you see the market more clearly, hit like. And if you want to see more structured rule-based trading strategies, subscribe and I'll see you in the next video. Happy trading!